This is OG John. I was asked why I had been discussing oil for the past few days. You have your response today. WTI at 87, Brent just broke $90. Within weeks, Qatar will issue a warning of 150. For this reason, we discuss more than simply precious metals in this article. You must view the entire image, each variable, each connection, and each asset class. You can only achieve true independence in this way. You don't need me or anyone else to tell you what's going on. You can see it for yourself. You make the connection on your own. That's the objective. In order to assist you in getting there, it will be beneficial if you truly want to know how these markets function. Leave a comment if you are learning something from this. It's just one word. Many people landed at once today. Stagflation has just been confirmed by a jobs report. For the first time in 2 years, oil broke $90, and Qatar warned that it would reach $150 in a matter of weeks. Shanghai's silver vaults have been empty for 15 days. The COMEX paper market is currently hollowing out. Silver is holding after rising from 81 to 84. While everything else is selling off, gold is rebounding. I'll walk you through it all. In February, 92,000 jobs were lost in the U.S. economy. A gain of 58,000 was anticipated. It's not a miss. That is a very separate course. The unemployment rate increased from 4.3% to 4.4%. This is the part that is more important than the headline. The average hourly wage increased by 4%. Wages are stagnant and jobs are vanishing. There is a name for those two simultaneous events. It is not a soft landing. Stagflation is what it is. The Fed cannot reduce rates without causing inflation to rise. It cannot continue tightening without exacerbating the loss of jobs. There is no easy way out of that trap. Today, the market began pricing precisely that. The Nasdaq fell 1.5%, the S&P fell more than 1%, and the small cap Russell fell more than 2%. At the same time, yields decreased. The bond market is not indicating impending rate cuts when yields and stocks both decline in response to poor jobs data. It is a warning about the state of the economy. It's important to keep an eye on this shift in the way markets interpret data. Additionally, consumer spending stagnated and retail sales already decreased by 2% in January. While prices continue to rise, Americans have stopped spending. The Fed's 2-year promise of a soft landing has not been postponed. It is no longer alive. On top of that, add the war. For the first time in 2 years, Brent crude broke $90. WTI is currently at 87. The only viable solution with Iran, according to Trump, is complete submission, complete surrender, no talks, no ceasefire. If ships are unable to pass through the Strait of Hormuz, oil prices might reach $150 in 2 to 3 weeks. According to Qatar's energy minister, the cost of natural gas could increase by 400%. According to Qatar, if the conflict lasts even a few more weeks, the world economy will suffer. Kuwait has started reducing production and is currently debating restricting output to domestic use solely. Production of about 2.6 million barrels per day is under jeopardy. The Gulf's oil reserves are full. Iran is receiving real-time intelligence on the positions of U.S. ships and aircraft from Russia. Iran claims that its next assault will be more severe and extensive. This stopped being a geopolitical backdrop some time ago. It is currently the primary variable in every asset class simultaneously. And here's what this does to the inflation math the Fed is already losing. Inflation pressure increases by about 20 basis points for every $10 increase in oil prices. Oil is now around 87 instead of the mid-50s. That is more than a full percentage point of future inflation. The CPI is expected to surpass 3% at $100 oil as jobs are being lost. The Fed is not in a precarious situation. It's in a closed, doorless room. Now, silver, since the physical market today is saying something the paper price is still pretending not to hear. Western location is at 84. Shanghai spot is at 96, a $12 premium. But the premium alone is not the tail. The vaults are. Since October, the Shanghai Futures Exchange lost 77% of its silver inventory, plunging from 36 million ounces to 8.2 million. An additional 539,000 ounces left in a single session at yesterday's drain rate alone. Those vaults will be empty in 15 days at that rate. The Shanghai Gold Exchange reports a 64% decline from 39 million ounces to 14.3 million ounces. At current drain rates, COMEX recorded silver is at 91 days, a 34% decrease from the same period. 3 distinct continents, 3 distinct transactions, all emptying at the same time. Someone is aware of something. The fact that the majority of people are still unable to connect is as follows. For the past 6 months, silver backing COMEX futures contracts has dropped by almost 20 million ounces per month. The market is waiting for unanticipated inflows every day. That's easy math. In order to ration what is left, either the inflows arrive or the price rises dramatically. There isn't a third choice. In the meantime, trade volume has plummeted, and COMEX silver open interest has recently reached a 12-year low. In reaction, the CME reduced silver futures margins by 22% in a single action, lowering the cost of holding positions in a market where the physical backing is deteriorating the fastest. Additionally, traders are witnessing a 3-year low in SHFE gold open interest. All of the leverage positions are being unwound. While the actual market is collapsing, the paper market is contracting. These two events are occurring concurrently. It's not noise. This article is now receiving very little attention from Western financial media. It is also possibly the week's most important structural development. With effect from April 1st, India's securities regulator issued a circular mandating that all mutual funds and exchange-traded funds, ETFs, that hold physical gold or silver cease using the LBMA London fixing price as their benchmark for valuation. The domestic spot price pulled from Indian exchanges must be used. Uniformity is the official justification. The true cause is that physical metals could not be delivered from London quickly enough to satisfy Indian demand. This caused India's domestic silver prices to drastically diverge from London prices twice in the last 6 months, in October 2025 and early this year. Price decoupled, the arbitrage failed, and India's regulator discreetly changed the regulations to reflect actual market conditions, rather than the paper benchmark. When one of the biggest consumers of silver in the world formally departs from LBMA, you are witnessing the real-time replacement of the outdated systems architecture. Those who are keeping an eye on things can see how that will affect pricing power in the coming years. Now, the honest part in the price picture, silver recovered to 84, up 3.4% during the New York session, after rising from 81.60 at 8 this morning. Compared to a day before, the short-term tape is now cleaner. For that to remain true, it is impossible to go back to the morning lows at 81.60. This market shouldn't have to retest that level in order to move higher. The tape's next areas of interest are 85.50 and 86.80. This is not a signal, it's a tape readout. It is simply observing what the structure is displaying. Gold is at 5,149. It surged sharply on the 8:30 NFP print, gave it all back within 15 minutes, then pushed higher again as the dollar dropped. That is the pattern we have been monitoring all week. The algo pressure at 8 in the morning is still in action. For the tape to continue positive from here, we do not want pricing revisiting the 8 a.m. lows. If it holds above those and continues, the levels to watch are 5,180 and 5,200. But this still rests significantly on the dollar. The DXY is starting to seem weak on the chart, but it is not apparent yet. We talked about the same plan. There has been no change. This is not a signal, it's a tape readout, simply looking at what the structure is displaying. The bear case is genuine. When there is little volume, the price can swing in either direction due to thin participation. Paper shorts are equally inexpensive to retain as longs do to the margin cut. War headlines entail tail risk in both directions and are subject to hourly fluctuations. It's unclear what the dollar resolution is. The structural picture remains unchanged. This is what was verified today. On the same day that oil broke 2-year highs due to conflict escalation, the jobs data disproved the soft landing theory. The Fed is dealing with both rising unemployment and rising inflation at the same time. Consumption in retail is declining. With no significant inflows, the physical silver market on 3 continents is at multi-year inventory lows. LBMA is being discreetly removed from India's pricing system. Additionally, as the physical squeeze tightens, the paper market is contracting. What happens to COMEX registered silver over the next 30 days as SHFE gets closer to empty is an issue worth keeping an eye on. A silver market is not functioning normally when the Shanghai Futures Exchange has only 4 days' worth of world mine supply in its vaults. In that market, the paper-physical divide is turning into a structural issue rather than a cyclical one. After this margin cut, pay attention to the positioning data. Keep an eye on the direction of open interest. The following chapter begins to compose itself at that point. Examine the COMEX inventory reports. Check the CME margin information. Invest rationally rather than hysterically. See you on next video with more market news.